Hello everyone. In this video, we'll be talking about RBI's monetary policy, especially in the light of the rate cut that happened recently. So, how is RBI's rate linked with the banks? So, I'll first be talking about some concepts before getting into specifics. First of all, there's something called liquidity adjustment facility, which comprises of the repo rate and the reverse repo rate. On the other side, we have the marginal standing facility, which is linked to the MSF or marginal standing facility rate. So we'll first understand what these three concepts really mean. Okay. Repo rate is the rate at which RBI lends money to commercial banks. So this means that the commercial banks can borrow from RBI at the repo rate. So if the repo rate is reduced, the banks can obviously, which means get money at a cheaper rate. So obviously they will be able to borrow more, there will be more liquidity in the system, and in short, in very layman terms, there will be more money around. Reverse repo is the rate at which RBI borrows money from commercial banks. Now obviously RBI doesn't need to borrow money, so what this effectively means is that at what lend, if the commercial banks have extra money, so at what rate can they give it to RBI, so and get some interest over it, so that is the reverse repo rate. Now what is the marginal standing facility? That is basically a window for banks to borrow in emergency situation where interbank liquidity dries up completely. So if the banks generally are supposed to lend and borrow amongst themselves, so the interbank liquidity. But in a special circumstance when that is not forthcoming and the banks really need some money, what they do is they pledge government securities or G-Secs and they can borrow some money. Now this is at a rate which is higher than the repo rate. The RBI says it will borrow any amount of money as long as you can pledge the government securities. Okay, there are other concepts which you may have heard. Base rate is the minimum rate below which banks do not lend, barring certain exceptions. So RBI guidelines are there that say that no bank can offer loans at a rate lower than the base rate. Cash reserve ratio basically means that amount of funds that the banks have to keep with the RBI. So this means that when they are, so as a ratio, the banks are supposed to keep certain funds with the RBI for, so this is basically to, so that RBI can control the credit. So for every loan that you give out, you have to keep certain cash reserve. Then there is the SLR or the statutory liquidity ratio. This means that the banks require to maintain in the form of gold or government approved securities. Again, this is for the banks so that they have certain sort of money in liquid securities. So like gold or government securities. So that is the SLR. Again, this is an instrument which can be used by the RBI to control credit. So if they increase the SLR, there will be more money locked in the form of gold or government approved securities. The banks will not be able to lend that money. Okay, in January 2015, what happened? Suddenly, this was unexpected. The repo rate was lowered by 25 basis points, that is, it reached 7.75%. The reverse repo, the difference between the repo and reverse repo rate is always 1%. This has been fixed recently by RBI. So the reverse repo rate was adjusted to 6.75% and the MSF was lowered to 8.75%. The cash reserve ratio was kept constant at 4%. So why has the RBI gone in for the rate cut? There are various reasons for that. Firstly, the inflation in the economy has eased a lot. So inflationary pressures have been easing. There are various factors for that. One is there's been a global commodity price fall. So obviously the prices of commodities coming into India has also fallen. There's another video explaining that. Similarly, there's been a very dramatic oil price crash, again leading to lower inflation in India. So basically inflation has been reducing. The second point is that the government has assured to stick to the fiscal deficit target of 2.1%, which means it is saying that it'll try to have as much fiscal consolidation as possible. So how does fiscal deficit link with inflation? In very simple terms, fiscal deficit basically means that the government is spending more than it is earning. Now if any person is spending more than it is earning, so he needs extra money. So the government, what it does in, again, layman terms, is basically it creates more money. So either it will go for, the RBI will have to monetize that debt, or whatever it does, it will basically lead to a higher, it's basically leading to more money in the economy, it will lead to a higher inflation. So if the government does stick to the fiscal deficit target, the RBI will be assured at that end that there will not be inflation from that side. Similarly, there's another theory in economics which says that inflations are affected by the inflationary expectations that economic agents hold. Because whatever expectations you hold, you will act in the same manner. So this is not exactly a very proper example, but just to still give you an example. If, let us say, I expect the prices to rise tomorrow. So I am a seller. What I will do, I will lead to hoarding. So I will not sell today. So effectively, even if the prices were not going to rise, what will happen is if everybody starts hoarding, the prices will rise. So there are various reasons, but if there are higher inflationary expectations in the economy, the economic agents behave in a manner which will lead to higher inflation. So there has been data to show that the household expectations are easing to single digits in terms of inflation. So there are various, again, reasons for that. First of all, with the new government coming in, the people are expecting a lot of action to be taken on the economic front, because of which they feel the inflation will be falling. Similarly, when they see around them that the oil prices are coming down and commodity prices are coming down, again the inflationary expectations ease. So these are the reasons because of which the RBI has had elbow room to cut the rates, because the inflation has really been easing. So again, it's not just a rate cut, it signals a shift in the stance of monetary policy, which means we're going towards a stance of easy monetary policy or increasing liquidity in the economy. So now estimates of cuts in the year have been revised to ranging from 50 basis points to 150 basis points. Similarly, banks would cut their base rates, leading to monetary policy transmission. So like I told you, the base rate is the rate below which you cannot lend. The banks have to declare that rate. With the cut in the RBI rates, what will happen is that banks will cut down their base rates. So the other economic agents in the economy will also be able to borrow at a lower rate, which means that monetary policy has transmitted. So RBI's basically point is that now people should get money at a cheaper rate, so that the economic activity in the economy can take off. Okay, future easing would be linked to certain factors. Key to further easing are data that confirm continuing disinflationary pressures. So if there is a contrary data which comes in, or there is a shock or something which leads to inflation skyrocketing again, then obviously we will not be expecting any more easing from the RBI. And another thing is that the government has promised that it will try to contain the fiscal deficit. So another critical issue would be to see that sustained high quality fiscal consolidation, as well as steps to overcome supply constraints are taken. So this means there are two things in there. If the government does not keep its promise and has a high fiscal deficit, then again RBI will not be able to ease any further. And also the supply constraints have to be overcome. If there are supply side constraints, there's another video on inflation where you can see that inflation can be caused because of the supply side factors also. So even if your everything else is okay, but if the supply constraints are not removed, or some new supply constraints come in, the inflation would be high again, and it would be very difficult for RBI to cut rates in that scenario. And also the government needs to assure availability of key inputs such as power, land, minerals and infrastructure, which would ensure that the potential output rises above the projected pickup growth in coming quarters so as to contain inflation. Again, this is the same thing. If these things are not available, then it will cause the inflation to rise, because the supply of things will not be in that much of a quantity as compared to demand. So for instance, let us say industry needs land. Let us just take an example of manufacturing cars, and that cars or anything. So that industry requires land, but that land is not forthcoming because of, let us say, government regulation. In that case, what will happen is that obviously the demand is already there, but the suppliers are not able to supply as much, which would mean that effectively the prices of the cars would go up. So if you can see all these things, if this happens, then the prices in the economy would start rising again. Similarly, power, or land for minerals to create various things. So it's the same thing. It's about the supply side. So this was basically our roundup on what are RBI rates, and also what does RBI think before it can change its stance on monetary policy. Thank you for watching. Hope you like the video. Comments and suggestions are welcome. Thank you.